Mic check 1 2 1 2. Mic check 1 2 1 2. All right, so the mic is working on my end. Let's get to it. Let's get straight to it. Now, this is options class part 1, call options, and in this class, you are about to learn what a call option is, why people buy call options. You're going to learn how to buy one on the Robinhood app. We're also going to learn delta, theta, ask and bid. You're going to learn what a limit order is, what in the money means, what strike price means, what open interest and volume is. So all of those things, that's what we're going to be studying today. However, we want this to be really quick so you can watch it again and again as needed. We're going to use bio-nanogenomics as an example, and this is bio-nanogenomics. Currently, they are $5.06 a share, but in our screenshot here, we're using Robinhood's interface. Yes, this is live, but it won't be if you rewatch it, but we want to get this done quick. So bio-nanogenomics, at this point, it's $5.13. Now, what is a call option? A call option is a contract. All options are contracts. And the reason they're called options is because they give you the option, but not the obligation to then buy shares or sell shares. But in this case, with a call option, you have the option to buy shares if you so choose. Now, if you get to the expiration date or any time before then, you have the option to buy those shares with the call option. Now, for example, let's say that you and I were going to buy some water bottles, right? And then there's an entire pack of water bottles. You know that each of these water bottles are selling for $1 each at the time of this recording. Okay, now let's say that you get a contract that says that you can sell, or actually that you can buy every single one of them, right, for a strike price. What is the price? $2, right? Who would buy this contract? You know that all of the water bottles cost $1. Why would you buy a contract saying that you have the right to buy it at $2 when they all cost $1? The reason is because you are speculating and you think that the price of water bottles will go up. So let's imagine that when you bought this and every single one of these water bottles cost $1, but your contract says that you can now buy them for $2, your contract is now worthless. It's out of the money, they would call it. But if it was to go in the money, meaning water bottles shoot up in price, something happens, a pandemic happens or something like that, and now all of the water bottles are currently $4, $5 each, but you have a contract saying that you can buy them for $2 up until a specific date. Now, let's get right to the facts. So, bio-nanogenomics. Instead of water bottles, we're talking about stocks. And we're going to use the exact example again. Currently, this water bottle is $5, right? This stock is $5, but they're coming in a group. They're coming in groups of 100. Okay, now you can buy the right to buy this at $6. But why would you buy the right to buy this at $6 when it's currently $5? Because you anticipate that it'll go up even higher than that. So here we go. On Robinhood, if you were to click down here and click trade, what you would see next is this, trade options. Now you click trade options, and if you can't see trade options, this means you need to apply for options. You can click the link in the pinned comments on Learn Options tab, and then you'll see on Webull, Robinhood, wherever you want to use, you have to go and apply for options. Now, let's go here. You click trade options, and notice you want to pick a date. Remember with our water bottle example, any contract has two main components to it. It has a price, like the $2 water bottle, and then it has a date. For example, let's say November 1st. So with the water bottle example, you would have until November 1st, and you can pick these things up for $2 until this date, right? But with BNGO, let's say you were to pick, let's call it October 15th, right? You pick this date, October 15th. Okay, now once you've clicked that, what you want to do is click buy, call. Click buy, call. Now, at this very moment, you are getting ready to buy what is called a call option. You basically buy a call option when you want to get into a stock before it runs up. Okay. Now, these here, these rectangles are the break-even prices. Notice they're split. They're split here. In the middle, this is called at the money. And currently it shows you the share price of $5.15 or $5.13 per share. Every share BNGO is $5.13. Now, at this current point, everything under here is called in the money. Everything above $5.13 is out of the money. So let's take a look. 8, 7, 6. These are out of the money because all of those numbers are higher than $5.13. Now, $5 flat, $4, $3, all of these numbers are lower than 513. So these are considered in the money and these are considered out of the money. Okay, now let's keep looking at our break even. Notice that if you buy a call that is in the money, the break even is lower. What is break even? Break even means how high will this stock have to go in order for you to make money by the expiration date. But we tend not to hold until expiration because there's something called theta that will eat away at your option, and we'll get to that later. Now notice the break even price here. If we bought a $5 strike, the strike is the price here. So let's say that we were buying the water bottles. Our strike price in our water bottle example was $2. That would have been our strike, right? Okay, so now here, our strike on Robinhood, we could pick up for BNGO a $5 strike, and we would need it to go up to $2 or 2%, almost 3% to get to our break even. Okay, what if we wanted to go a little more out the money, right? Because notice, what price will we have to pay? $28 to get the $5 call, but we could pay $4, significantly lower, to get one that is out of the money. But it comes with a risk. The risk is that it's less likely to earn money and more likely to just expire absolutely worthless. But if it goes in your favor, you will make more money. With higher risk come higher reward. As simple as that. Okay, now that's what break even is. And notice on Robinhood, the break evens are accompanied by the specific number. So if we were to pick up this $6 call right here, and let's go up one more slide. So notice, let's say we pick this $6 strike. The strike is the number, the dollar amount that you pick, right? So for example, with the water bottles, it was $2. That would have been our strike. And then our date, let's call it October 15th. So you are saying that you're going to buy this one. It's going to cost you $4. You see 4 cents here, but you have to multiply it by 100 or move the decimal point 2 over. Okay, now we would need this option if we decided to hold it all the way to the expiration date of October 15th. We would need it to go up 17%, but you will not need it to go up 17% if you get out of it before then. Now, that 17%, that's $6.04 exactly. This is why we're using Robinhood to show you, because Robinhood has a simple to use interface. Now, let's say we were to click on this one as if we wanted to buy a call, a $6 strike. This is the number, $6 strike. And now let's see what happens when we go in here. So when you click in, you'll see all of these different numbers. Let's highlight the volume and the open interest. This is one of the first things that I want you to see. Now, the open interest, you want it to generally be over 1,000. This tells you basically how many people or how many contracts of this exact contract are already out in the world and people have already picked them up. Now, the volume shows you how many of these have been traded on the day. Open interest and volume. Okay, now, let's take a look and let's scroll up a little bit more. Now, the ask and the bid. You want to buy this option, and notice 12,000 other people did as well, or there are 12,000 of these contracts already out in the world. Now, currently, what are they going for? What is the price? Now, the ask price. This is what people who are selling it for at this very moment. And there are basically 530 or 553 contracts being sold at this 4 number right here. Right? 4 cents, but you would have to buy it for $4. That's how it works. You times it by 100. Okay, now, what are people trying to pay who are also trying to get into the play? That's the bid right here. Now, the bid, notice, there's 19 contracts basically that they're trying to pick up 19 of those contracts for $3 right here. However, most people are selling it for $4. So if you want to get in right now on an option, you have to use the ask and pay the asking price. Okay, now, take a look at Delta all the way down here. Delta. Notice, if you were to go and buy BNGO, and let's look at the share price again, right? The share price is down here at 513, and we can go even more granular with it and take a look at the share price at 513. If you were to buy 1 share of BNGO, and it went up from 513 to 613, you would have made $1. But if you buy one of these contracts, one of these options contracts, and this is why people do it. If you buy one of these $6 strikes, right, the $6 strike, you know the break even is $6.04, right? And you had to pay $4 for it. But if you were to buy one of these and you bought it on the ask price because you wanted it right now, then you look at Delta. Now, if this stock goes, BNGO, just the stock, not the contract, the stock goes from $5 to $6, then just going up $1. Delta tells you what number is going to be added to the price that you paid. So if you paid $4 and you're in it, 100% of your worth is $4, then you would basically jump this by $12, family. $12 would be added on to the $4. So you would have turned a $4 account, and then all of a sudden it would say $16, family. That's huge. That's a really big come up, right? Delta is excellent for this strike price. Okay, or not this strike price, for this ask price. Now, let's go on over here because it's not all good. There's something called theta. Like I see in the comments, theta gator, right? Why do they call it that? Because it's like an alligator and it's eating away at your option every single day, whether it's going in your favor or not. So if you pay $4 for this, remember we moved the decimal point 1-2, and we paid the asking price. We could have paid the bid price, but we may have had to wait for more people who decide to jump in and they're now asking for $3. We could have paid the bid, but then we wouldn't get in right away. Now, theta, let's say that we paid the $4, move the decimal point 2 points over, 1, 2, right? That would mean that we would have lost 71 cents every single day on this contract, whether it was going in our favor or not. Okay, now let's take a look at this. BNGO. See this? This is the limit price right here. We see that bid again, the bid from before, the $3. And let me zoom this in so you can see it a little bit better. You see that bid is $3 and the ask is $4, which we already knew. Now, we could decide to pay, and this is the limit price. This is what are you willing to pay for this, right? What are you willing to pay for this? That's what limit price means. So we put the limit. We're willing to pay what people are asking because we want it right now. So then we put in this number. But if you wanted to wait on a dip or something like that, then you could put your limit price to something like that isn't even available here. Like, for example, people are currently trying to pay $3 to get in, and people are saying, look, I'll give you this for $4. But you could put 0.02 or 0.01, but you'd have to wait. And if it came down and dipped, then you'd be ready and you wouldn't have to watch. But we put in the ask price. Now notice, we bought one of these contracts, right? One of the $6 strikes by October 15th. And the max cost is going to be $4 because like I told you before, you have to do it and times it by 100. So then you look down here, what is your profit? On a call option, your profit is unlimited because stocks can theoretically go up to infinity. Your break even is going to be 604. However, your max loss is what you paid for the contract. So there's a limited amount of loss and you would lose what you pay for the contract. So in summary, what is a contract or what is an option contract? An option contract basically gives you the right to purchase, or in this case, a call option contract gives you the right to purchase 100 shares at the strike price by the date that you chose. However, we don't tend to hold because we're not really looking to get into 100 shares of this. We're looking to sell this contract to somebody else. Because, for example, let's say that just tomorrow, we don't have to wait till this date. Let's say that just tomorrow, out of nowhere, BNGO went from where it is right now at 513, all of a sudden to tomorrow, it is 613. It is 613. You see what I'm saying? So then you'd be up from $4 all the way up to $16 because Delta, remember, Delta, if it goes up $1, the entire contract is going to go up by Delta, and Delta was 12. So then you pay 4, and then it goes up $1 in the stock. Delta would show you what would happen with that, right? And then now we're all the way up to 16. So you could get out of it right now and sell the contract at its new price, which would be 16. It was 4 when you bought it, but now it's 16 tomorrow. You could just sell it to someone else and don't even worry about buying the 100 shares or anything like that. So that's why people buy it. I just showed you how to buy on Robinhood if you follow the steps that I just did, which basically you go and you pick an option. You say, okay, look, BNGO came down a lot. I'm going to go to trade. I'm going to go to trade options. Boom. And then I'm going to pick a date. When do I think it's going to hit $6? Let's say, hypothetically, October 15th. You click your date up here. Okay, great. Now, you go to buy a call. Selling a call or selling a put or buying a put, these are totally different. And we'll get to those in maybe part 2 or 3. But now, you pick a number. Let's say you pick the $6 strike. Now, you may pick the 7. You may pick the 8. And remember, the further out of the money you go, the further away you go from the price and you go up, notice the options are cheaper. And they're cheaper because there is more risk. There is more risk there. Okay, now And then delta, again, if the stock goes up $1, your contract is going to move up by delta. Theta, every single day, your contract is going to decrease in value by whatever theta is. The ask and the bid is what people are willing or trying to pay for this option right now. The ask, this is what people are selling it for right now. If you wanted to get in right now, what is in the money? In the money, if the stock price is $5, everything lower than 5 or 5.13, everything lower than 5 is in the money. Out of the money, everything above this is out of the money. And then we go to strike price. The strike price is the dollar amount that you are going to pick. That's the strike price. And then let's talk about open interest. Remember, we're talking about open interest over here. The open interest, you want it to be at least 1,000. At least 1,000. You can get in for lower than that, but generally you want to have people interested in this contract so you don't get trapped in it and you can sell it. Okay, now, volume, this is how many people or how many of these contracts were traded today, but the open interest is more important, in my opinion, than the volume, because this is showing you how many people are actually interested in it totally, how many of these contracts are out, and this is how many were traded on the day. Okay, now there are more parts to this, but that's it. That's pretty much it. And I wanted to redo this video just so you could see it and understand, have a base understanding of options, quick, fast, in a hurry, straight to the point. I love y'all. Now, options class part 2, be on the lookout for that. But if you can't handle the heat of these hot stocks, then stay out of the kitchen family and consider investing in the index funds. And again, hit that like button for your boy. I love y'all. And I will see you in the next one, family. Hold up. Let me find out where this button is so I can end the live. Here we go. Here we go. Are we here? Nope. I have no idea. But you know what?